All right, everyone, welcome back to Money Show's accredited virtual expo. We are pleased to welcome Jay Mensmeyer. He's a renowned maritime shipping analyst who directs the Value Investors Edge research platform on Seeking Alpha. He's a frequent speaker at industry conferences, is regularly quoted in trade journals, and hosts a popular podcast featuring shipping industry executives. Mr. Mensmeyer also hosts regular virtual investor forums, which are a must attend for anyone interested in the shipping and infrastructure industries. So we're pleased to welcome now Jay Mensmeyer. Jay, thank you so much for being here. It's all yours.
Excellent. Thanks, Mark. Thank you for the introduction. Good afternoon, everybody. I guess still good morning if you're joining us from the West Coast. I used to live out in Las Vegas, so I definitely sympathize. Before we get started, just a quick introduction of what we do and who I am. My name is Jay Mensmeyer. The first name is just a letter. I am the head of research at Value Investors Edge. That's a private research community. It's hosted on Seeking Alpha. You can sign up there for yearly or monthly memberships. We actually have 2-week free trials available just for the next 48 hours in conjunction with this presentation. So if you want to just jot down mensmeyer.com, that's the direct link. It'll take you right there. Check out our webinar over the next 30 minutes. And if you like what you hear and you're interested more in the sector, come check us out. Free, zero obligation free trials. I'm also on free Twitter. We have about 11,000 followers. So you can follow me for free there and I'll try to engage as best as I can. So before we begin, just a quick introduction again of the past webinars we've done. I've done 3 of these over the past year. This will be the 4th. And over the past year, and I wanted to review some of the past picks and performance. Of course, past performance doesn't guarantee future results, but hopefully it'll at least still whet your appetite for a little bit more here. So last August I came on, I talked about outsized return potential in maritime shipping. I shared top 5 picks in shipping, and those returned 38.5% in 4 months. 4 out of 5 of those were positive, and the median return was 23%. Why do I say 4 months and not a year? The yearly return is actually over 100%. I say 4 months because that's when I came back on to the next Money Show webinar. So we'll kind of skip between each webinar here. So the S&P 500 was up 12% in the same period. So we outperformed by 26% in 4 months. And that was from the Money Show webinars, and our private model portfolios did even better. On December, we came on outsized post-COVID recovery potential. We had 5 picks, 38.8% over the next 4 months. All 5 were positive, median return of almost 25%, outperformed the S&P by 28%. And then finally, I was on in April, about 3.5 months ago, talking about riding the global economic recovery. Our top 4 picks returned 16.2%, 2 out of 4 were positive, so a little bit more mixed there, but the median was 12% returns, and outperformed the S&P 500 by 8%. So sequentially, those are about 4-month returns. If you annualize them, it's about 138%. Past performance, of course, doesn't guarantee future results, but hopefully at least you'll be a little bit excited for some of our top picks today and get your notepads out. So what are we going to talk about today? We're going to talk about our research background, what Value Investors Edge is all about, and how we outperform. We're going to talk about what COVID-19 has done to the shipping sector and how we're coming out of recovery, how the stocks have done year to date. And then we're going to hit the 4 hottest sectors. I picked this title about a month ago when the shipping stocks were a little bit higher year to date. But listeners today are lucky because we've actually had a pullback over the last 3 or 4 weeks. And even today, a lot of these names are down 4, 5, 6% today, even as rates are setting fresh record highs. So it's a little bit of a great time to be buying. It's a little bit of a trough. So a nice opportunity, and just totally lucky that it coincided with today's Money Show presentation. In the very end, I'll try to keep 5 to 10 minutes available for Q&A. So if you think about your questions, I kind of hold on to them for a little bit in case I answer them throughout the presentation. But then at the end, feel free to submit a few of those and we'll jump right into them. So how do we profit and outperform in this segment? It's pretty easy. We stay exactly in our lane. We don't venture out and talk about things we don't know stuff about. So don't ask my opinion on Amazon or Apple or Tesla or anything like that. I only focus on maritime shipping and trade infrastructure. We have a full-time macro analyst who focuses on the macro side of the sector and commodity markets. We work with an energy and income specialist who focuses on the MLPs and infrastructure on that side of the house. And then we have a full-time analyst who just focuses on maritime shipping. So we are very, very focused, and that leads to our outperformance. And you can see our outperformance since 2016. On the left, you see Value Investors Edge return. It is a 39.7% annualized return as of last Friday. This is not audited, of course. So this is just based on our model portfolios and our trades. But you can see a significant outperformance of the small cap benchmark, which is the Russell 2000. And most remarkable, if you look over on the right, you'll see that the shipping industry was actually flat to negative over this time period. So not only did we destroy the market comp, or the market overall, the small cap market, we did so in a time when the industry tailwinds were not always in our favor. So I get a lot of folks that push back at me. They say, why are you into shipping? It's a tough industry. Haven't you seen, Jay, that the returns are flat to negative over the last 6 years? Well, why, yes, I have, but I've also seen a lot of dislocation, and we've also been able to take advantage of a lot of that. So what did COVID do? What happened with the stocks last year? Well, it decimated the shipping stocks. And that makes sense on a common sense perspective. You think about a global pandemic and you probably don't think it's going to help shipping. And of course, people vote, short term, the market is a voting machine and people vote with their common sense, and they decimated the shipping stocks. However, that's not really what happened last year in terms of the fundamentals. Most of these companies did very well last year. Even the segment that was most hit by COVID, which was tankers, actually had a very strong 2020. So a little bit different in the actual fundamentals, but the stocks did very poor. Not only did the stocks perform poorly, they did not recover in April and May and June like most of the other stocks did. In fact, they didn't really start moving until September or October. Last August, when I was on here, MoneyShow, only 2 out of the 55 names we followed were positive. When I was on here in December, only 4 out of the 55 were positive. So 93% of shipping stocks were losers last year. That's remarkable. There's only 4 winners you could have picked during 2020. So as a result of that, the shipping stocks hit all-time record lows, which for us is a buying opportunity. And of course, we had to take advantage of that. Sector performance, the same stuff we just talked about, massive crash when COVID started, then really no recovery through August. Everything recovered except for shipping. And then the end of the year, shipping took the lead. It went up about 25%. It says 18, but that's through the MoneyShow presentation I did. Went up about 25% to end of the year, but barely keeping pace really with the Russell and NASDAQ. It wasn't really until 2021 that the outperformance became supercharged. And why did they lag? And I've talked about this before, so apologies for repeats if you've been here, but very bad screens. Value, nobody wanted value. Small cap, people hated those. International stocks, commodity stocks, higher leverage on average, and China exposure. Just everything people did not want to see in a stock. And keep in mind, most shipping investors, I put it in quotes because investing in shipping is a little bit shorter term. We're more like cycle traders on average, but most shipping investors are deep value oriented. These are folks that look at the fundamentals, they consider the macro, they look at where the broad market is at. And a lot of folks, myself included, were very skeptical about how the market would respond during COVID. I'm actually pleasantly surprised on how our economy is performing. Maybe I wasn't quite that bullish last year. And so a lot of folks like myself that are deep value type orientated didn't really want to get into shipping last year. And then finally, there's kind of a challenging history of sector returns. We already talked about the kind of mediocre returns. And then the governance. That's not as much of a problem anymore. There's really only a couple names that have bad governance that we stay away from. But the average governance 10 years ago was pretty poor in the shipping sector. And people have long-term memories and they remember that. So there's this negative stigma attached to shipping. And why did this finally change? And so first of all, in the early part of this year, the value investors started to come back. They realized, wow, the economy is really doing well and there's a lot more legs to run on this thing. They looked at shipping and they said, there's a record low pricing in the stocks, there's surging cash flows, and there's an excellent supply versus demand balance here. I'm going to put some money to work. And then those value investors came in, they put some money to work. Secondly, we had surging cash flows and strong reports coming in. It started with Q4 of 2020, but Q1 21 was even better. And Q2, which is starting this week and next week, is going to be even better. So you can expect significant dividends and probably some repurchases across most of the industry. It took a while for the rates to start resulting in stronger returns. And then the companies focused on deleveraging, taking out some of that high cost debt. But now that that's accomplished, the next step is shareholder returns. So we're really, really excited about that. The third thing, and I put it in red because the last 3 to 4 or 5 weeks, it's been working against us. And that's kind of the inflation, or some people call it reflation trade focus. And that's sort of an extension of the global commodity boom and trade that we've seen. Like, I'm sure most of y'all are familiar with the lumber kind of boom and bust. And lumber really has nothing to do with shipping, but it is part of the broad kind of macro commodity theme. So shipping is a phenomenal inflation hedge, probably one of the best inflation hedges in the world. The rates and the vessel valuations always rise. They're going to rise with inflation. And meanwhile, your fixed cost debt, which is what a lot of the debt is, will reduce in value with inflation. So you have two levers moving in different directions, which leads to significant potential net asset value, earnings per share growth. Now me personally, I'm not really in the expect mega inflation camp myself. I'm a little bit more nuanced on that. But if you are expecting that, it's honestly beyond my capacity to project future inflation rates. I think Fed bankers, and all those folks can't really figure out exactly what the inflation is going to be. But if you do want to hedge inflation, or you do believe it's going to be high, shipping is probably one of the best segments in the world to allocate yourself into. That's kind of been working against us the last 3 or 4 weeks because the 10-year treasuries have been going down and people are a little bit less worried about inflation and that sort of thing. And so that kind of has been working against us. But in the longer term, I think that's a tailwind. So let's get into the stocks and the segments for the next part of our presentation. So performance year to date 2021, I mentioned it's been a great year. As of today, this is including the pullback we're having right now as we're speaking. The speculative model portfolio, this is about 2 hours ago, is up 115% year to date. The risk reward model portfolio is up 57% year to date. So we've had a very nice run year to date, and you can see that in this chart. The blue at the top is the speculative, and the green is the risk reward. You can see the speculative has pulled back a little bit. It's back to about late April levels. And you can see our risk reward has pulled back a little bit. It's back to about late May levels. So it's been kind of about a 2-month headwinds, if you will. The headwinds have been about 1 month, but about 2 months worth of values came off. Meanwhile, the rates have gotten better and better. The net asset values have gotten higher and higher. The earnings per share projections are higher and higher. So basically, these stocks are phenomenally good deals, considering that they pulled back 2 to 3 months worth, yet all the fundamentals are stronger. Now that purple line is a shipping index. That's an index we've made at Value Investor's Edge, but includes all the shipping stocks we follow on average. And surprisingly, you can see the shipping index, it's up about 38% year to date. But you can see it actually peaked in February. So if you just came in here and like, I'm not going to listen, I'm not going to do any research, I'm just going to buy shipping stuff. And you just bought like an average of shipping stocks, you didn't follow research or whatever, that's where you'd be. I mean, you'd be down since February. Whereas you can see how the Value Investor's Edge model portfolios have done. Of course, everyone's performance may vary and that sort of thing. And this is not investment advice, but you can see why we like this sector. It's where we've been able to consistently outperform the markets. So let's finally turn to it. Let's talk about the hottest markets for 2021 and 2022. Now, they were really hot about a month ago, but I still believe fundamentally, if anything, they're even better than a month ago. So container ships, dry bulk, LNG, and tankers. And they're kind of in order because the first two are really the strongest, and they're very strong right now. Container ships, a little bit more shorter term. Dry bulk is turning into what looks like a secular upturn. LNG is a long-term story, but it's also strong right now. Tankers are a deep value recovery play. Don't expect strong results this year. Look for a recovery potentially mid-22, but for a more deep value person with patience, that's where you kind of want to look at, kind of where the puck's going, if you will. So we'll start with container ships. This is a global restocking versus logistics bottleneck story. A lot of people have simplified it and said, well, it's only because of COVID. That's not exactly true. The container ship markets were already turning up very strongly in late 2019 into January before COVID started impacting the market. So the market was already extremely tight. Then COVID hit and everybody did kind of this knee-jerk shutdown. Everyone stopped ordering ships. Everyone stopped upgrading the ports. A lot of the workers went home. And you have a result of 10 years of underinvestment in global trade infrastructure. Ever since the global financial crisis, 2008, 2009, economies across the world, particularly in Europe and the United States, have underinvested in everything related to infrastructure and ports and trade and all that sort of stuff. So now you have everyone's trying to restock. The economy is opening back up because of COVID. You already had a super tight demand supply balance in late 2019. Now you have this like supercharged catch-up trade going on, and it is falling apart and breaking and having issues at every seam. And it's not just, people talk about the Suez Canal blockage, and we've had a lot of talk about COVID outbreaks in China and stuff like that. It's not just one place or the other place. It is across the entire world. The entire world's logistics supply is under-equipped to handle this sort of supply, and that's sort of the disruption we're seeing. Phenomenally, on the shipping side, the supply growth next year in the 2022 is smaller than the supply growth of this year. I mean, it's hard to believe. You have these all-time record high rates, and yet the supply growth actually goes down. That's because it takes 2 or 3 years to order one of these ships. So in 2020, nobody was buying any vessels, which means the 2022 order book is beautiful. It only has about 2% growth. So there's a potential for these rates to carry on far longer and far more robust than I think a lot of people are giving it credit for. The average container ship rates are at all-time record highs for 6 straight weeks. So we hit that level back in late May, early June, and we've been setting it for 6 consecutive weeks straight. So our top pick in containers, it's one of the ships that, one of the companies that owns the ships and leases them to the liners. Really more of a financial leasing play, if you will. They don't actually do a lot of shipping. They just own the ship itself. It's Global Ship Lease. Easy to remember. It's pretty obvious what it does. Stock symbol GSL. Some of the other companies down there, Atlas Corp, Costa Mare, Danaos Corp, and Zim. This is a good point to remind you that nothing on this call or this presentation today constitutes investment advice in any form. I'm long a number of these companies. I'm long every single one of our top picks today. I think you would hope that I would be eating my own cooking, but just a disclosure out there, I have long positions in many of these stocks. So in the shipping sector, we have strong consolidation trends, which leads to improved discipline. The top 5 liners control 65% of the market. It's 84% for the top 10. There's 2 major freight alliances which dominate the global markets and help with balancing things out in terms of where the boxes go, where the ships go, how the lines are set up. It's very, very similar to how global airlines work. In fact, it's a very similar share of the market of global airlines. Remember airlines, how that was, Warren Buffett made comments about how it was a terrible industry and how it was very unprofitable for decades. And then suddenly about 10 to 15 years ago, it became a really damn good business. That's kind of what happened with liners. It finally grew up, it finally got some sensibility into it, finally got some consolidation. Nothing on here constitutes an oligopoly or monopoly of any sorts. There's no market manipulation or anything like that. There was a sort of a federal note that caused some waves a couple of weeks ago with the Biden administration asking to look into that stuff. He's asking to look into the ports, and he's asking to look into some of the railroad structures and some of the ways that fees are levied at the ports. That's something that needs to be looked into, and our infrastructure is woefully undersupplied. So we need to see billions of dollars of upgrades done to our ports, and so it's a good thing that the federal government starting to look into this. But as far as illicit cooperation or competition, anything like that, that's not a thing in the liner business. It's very similar to the way airlines orchestrate. It's very similar to how FedEx and UPS and Amazon and XPO and those companies, DHL work. So there's a lot of misperceptions going on around there. Let's look at the 1-year leasing rates for containers. This is a 2-year chart. You can see the massive increase. This is the COVID downturn. It was already kind of strong, and then massive, massive increase, more like a check mark, not a V shape. And then the 20-year chart, this really shows you how strong things are. We are at almost double the previous all-time high, which is in 2005, 2006. So significantly strong rates. And what's worth noting is these are not spot rates. These aren't flash in the pan, here today, gone tomorrow rates. These are 1-year duration quotes. And what's even more fascinating is that these 1-year rates are not just 1 year. In fact, almost all the recent deals we've seen are 3-year, 4-year, and 5-year. In fact, mostly 4-year and 5-year deals have what's been being signed over the last few months. So, there's a lot of misperceptions about, wow, this is like some sort of bubble, or these rates are here and they're going to be gone tomorrow. They're going to crash tomorrow. Well, I already outlined how the supply all the way through mid-23 is very restrained. And we already talked about how it's 4 to 5 year deals that are getting signed. So yeah, 4 to 5 year deals, it's 2021 now. You want to call me in 2025 and ask me what the next deal is going to be? I don't know. But we're talking 4 to 5 year deals are getting signed at these rates. And a lot of these companies trade at about 1.5 to 2 times earnings. So a lot of these companies are fixing more revenue than the entire valuation of the company. It's just remarkable valuations. Finally, this chart is freight rates. So this is the actual shipping revenue that a liner company gets for moving those boxes around the world. And back in February and March, I was bullish on a company like Zim Integrated, which is a big liner company, stock symbol ZIM. And I thought, hey, the rates are going to normalize, they're going to pull back. They're not going to crash, but they're going to pull back to maybe 2,500, something like that. The exact opposite has occurred. The rates are up and up and up. They have went up about 60% since March. I thought they peaked in March. They're up 60%, 70% since March. And they were up Monday. They were up today. You couldn't tell it from the stock prices, but the freight rates are going nowhere but up. And we're into peak holiday season right around the corner. So very exciting things in the freight rates. I spent the most time on container ships because it is the most fascinating sector and the strongest one right now. Dry bulk is kind of next up. It's kind of about to have its moment. We have a global infrastructure surge and a tiny order book. We love a tiny order book. It means no supply on the horizon. So a lot of words on this chart, but basically what we're talking about here is global infrastructure spending is going to accelerate over the next 2 to 3 years due to COVID reopening and fiscal policies. And secondly, hasn't really gotten a lot of note yet, but all the future global climate change initiatives are going to lead to massive demand for iron, copper, cement, cobalt, bauxite, all these dry cargoes. And that hasn't got a lot of notice. A lot of people think, oh, environmental regulations, climate change, that's negative for shipping. Actually, in dry bulk, counterintuitively, for the next 3 to 5 years, it could actually be a major positive. Dry bulk shipping at the same time has the lowest order book in modern history. So you see this steady demand increase and you see no supply. And so you have a really, really good setup. We expect a huge surge in trade flows to begin. It's already started. We called it over a year ago. We said it was going to start happening. It's already happening. We expect it to continue throughout this fall and winter and really throughout the next several years. Finally, there's a geopolitical dispute between China and Australia, which has led to more cargo routes for coal. And that's really helping us out as well at the margins. So our top pick in dry bulk, right in the sweet spot, right where we want to be, is spot exposure, which means you take advantage of all the current rates, midsize, Eagle bulk. It's US listed, US headquartered, solid team, low enough leverage. They're going to probably start paying a dividend at the end of the year, early next year. Management team you can trust, totally defies all the shipping stereotypes. So that's our favorite by far here. And then some other ones, Genco, Golden, and Starbulk. So as we mentioned, the dry bulk market's extremely strong. I already talked through the main bullet points there of why that is. The only thing I want to kind of add to that is that 90% of the focus, or at least 90% of the focus I see in the media or with investors, is on the volatile Capesize markets. But in reality, all the strength is in midsize. And so you look at the Baltic Dry Index and see those little green X's here? These are the previous 3 MoneyShow presentations where I came on here and I said, look, you got to get into dry bulk. Infrastructure spending is going to accelerate. We got deep value positions. These are attractive stocks. Well, I got lucky. We got right. The dry bulk index is up. Well, let's look at Capesizes. Those are the large guys. So these are the biggest ones. You see a COVID pullback and you see a nice recovery, but a lot of volatility, right? Up and down. And you look across 2 years to 2019 and it's nothing special. And then you zoom out and you look at a 30-year chart and you're like, I mean, there's nothing here. It's just normal stuff. Like, what do you mean rates are on fire? They're just like normal rates. So, and that's the case in Capesizes. And see, the Baltic Dry Index is a size weighted index, a cargo weighted index. So the Capesizes have an outsized impact on this BDI. So the Capesize is doing nothing special, nothing even to write home about. And yet the BDI is looking pretty damn good. Why is that? Well, that's because as we start to look into the midsize, we look at the Panamaxes. There is a massive recovery post-COVID. The rates have tripled since COVID. We zoom out to 30-year chart and we can see that, yeah, wow, they really are strong. They're stronger than, the entire past decade. We're at like 13, 12-year highs, I think it is. And they're stronger than, 1990 through like 2003. So pretty good market. But we also see, okay, there's some precedent for higher rates. So they don't really look toppy. There's definitely some room to move. Now, finally, let's look at the tiniest vessels. These are handy sizes. Now, these are 50,000 deadweight tons or less. So they're only about 1/4 to 1/5 the size of a Capesize. So their impact to the BDI is very small. But there's actually a lot more vessels of this smaller class. And this vessel carries everything. I mean, it carries everything from forestry products, grains, soybeans, logs, all those sorts of things. It's not easily manipulatable. Capesizes, all they really do is iron ore between Brazil and China, and they do some coal in the margins, and they're easily manipulatable. Like if China says, oh, we're going to cut down coal inventories next month, or, oh, we need to slow down the steel mills, the rates, boom and bust. But these rates are really impossible to manipulate because they're so diverse. You have 10,000 vessels across the world doing every sort of trade and every dry product imaginable. And look at that 2-year chart. I mean, it's a thing of beauty. The rates have quadrupled since the COVID pullback. And now the all-time chart, this is really the winner. 30-year chart, you can see this spike in strength globally. This is like the workhorse of the market. And you can look across and you say, this is the 13th or 14th strongest month in 30-year history. I mean, it's just remarkable. And it really shows you what's going on in the dry bulk markets. There's really, really exceptional underpinning strength here. Don't get like sidetracked on these Capesizes that are easily manipulatable by China and focus instead on the mid and lower sizes, which actually show you what's going on globally. And you look at those charts and you start to really, really warm up the dry bulk. So I was moderately bullish, I'd say, the last 3 times I'm on dry bulk. Now I'm buying everything I can find. So I love it. LNG, quick story here. It's just a secular growth. We like it for the next 5+ years, maybe 10 years. There was a disappointment in the last couple of years. We had 2 very warm winters. LNG trade depends on Asia, Korea, Japan, China, using this for heating. That's kind of the historical demand. So warm winters were bad. However, last winter was a La Nina, which means it was really cold. That was good for our trade. And this winter is projected to potentially be as cold, if not colder. So we're looking for strong markets. There's 3 different classes of ships, and we only like to own the company that has the best ones, and that is Flex LNG, FLNG. They own 13 ultra-modern ships. The last one was delivered in May. They're all out there earning outsized returns. The US is driving this trade. They are becoming quickly the world's 2nd largest, the 3rd largest now, but they're gaining on Australia. And you can see the growth in trade started in 16, 17. COVID, a big V-shaped recovery here with COVID. This chart's actually delayed. This is that winter storm, remember, in Texas. The chart is only up to April. The blue X is more representative of where we are now, or where I think we are now. So very clear upward trend line. And we expect that to continue for another 4 to 5 years straight. And then there's a lot of seasonality in LNG shipping rates. You see each winter season here. So this is where we are now, clearly stronger than the last 4 years, but we're not yet to the seasonal levels. I'll look for those rates to spike probably late September, early October. And then finally, the LNG prices are surging in Asia. We expect massive arbitrage here. This is a 1-year chart looking at the January 2042 futures contract. Understand that's going to be a little bit complicated, but 6 months ago, this is about January prices. You can see about 6 months ago, sentiment changed big time, and LNG prices are on a rocket. Why is that important? It's important because almost all the gas is coming from Australia and the United States, and the United States is Henry Hub. That's like $4, right, for natural gas. This is $15.50. This sort of arbitrage, $4 to $15.50, could theoretically support LNG carrier rates to $300,000 to $400,000 per day. Now, I don't expect that. I don't think we'll see rates that extreme, but I'm just showing you the arbitrage potential. It's amazing. So if you're a shipper, you're seeing this chart, you just start drooling. Finally, tankers. This is the real deep value recovery potential. This is really all you can say about it. I mean, they got really crushed by COVID because you lost global demand, and OPEC was very constrained. Well, if OPEC's constrained on their output, you don't need a lot of tankers to ship the oil around the world. The market's recovering, but it's slower than we thought it would be, or I thought it would be. Delta is messing with us now, and we're seeing global air travel is slow to come back. Now we're expecting or hoping for normalization by mid to late 2022. So the timeline's pushed back a little bit on this. But the beautiful thing about tankers is they have one of the oldest fleet balances in modern history. They have a ton of upcoming regulatory changes around emissions, and there's no order book. So our top pick in tankers is International Seaways, INSW. It's a US listed, US headquartered stock. They're trading about 50% of net asset value. It means you can buy $1 worth of tankers for 50 cents. The leverage is very low. They're going to probably start a repurchase program here after they report the results. They just finished a major merger with another undervalued company. Now they're one of the largest tanker companies in the world. And so we're really bullish on INSW. Some of the other companies are shown below. And then again, order book is still at 25-year lows. This chart was taken from Euronav, recent presentation in June. And then the vessel supply. These ships in the red are completely obsolete. The only reason they're still trading is because they're doing illicit stuff with Iran and Venezuela. Once the Iran deal gets worked out eventually, we expect all those vessels to head to the scrap pile. And then all these ships in this yellow bucket are exposed to pending environmental regulations. Those environmental regulations start in 23 and they phase in through 2026. So we're expecting most of these yellow ships to be constrained. So this is gone. This is probably going to get gone or reduced. And then this light blue is the order book. So the order book is like 1/3 the size of the ships that are going to be gone. So we're really bullish about tankers. We just need to see the market normalize. So a quick review of what we picked. Container ships, we like Global Ship Lease. Dry bulk, we like Eagle Bulk. LNG, we like Flex LNG. Tankers, we like International Seaways. And finally, for our top pick, overall top value selection by far really is Zim Integrated Shipping. They're one of the liner companies that is actually moving the container boxes around the world. Think of a UPS or a FedEx of the ocean. That's what these guys are. We're expecting earnings of $22 to $26 this year, 2021. The year is already more than half done, 7 months down, only 5 to go. And the way the contract structure works, this stuff's 80% done already. We expect 22 to 26 this year. We're looking at 10 to 12 next year. That's very conservative. I think we could blow that out of the water, but I like to keep my targets low and easily to beat. And we expect 3 to 5 normalized thereafter, 23 to 2030 plus. So that's kind of what we're looking at for earnings. So just to sum that up, we're expecting 32 to 38 in earnings per share by late 2022. And we expect 3 to 5 each year thereafter throughout 2030. Our fair value estimate is $60 a share. It's almost like insultingly low. 60 is very conservative. There's a 74% upside. This crazy stock trades at 34, 35 bucks today. I've never seen something like this. I mean, we're looking at earnings of 22 to 26. And here's the cherry on top of this company. They are net debt free as of June. I mean, there's no debt at this company. So I've never seen a company that has no debt that is going to do more earnings in the next 18 months. Not even 18 months, less than that, because most of it's already getting fixed. 18 months in the entire stock price. I mean, it's remarkable. So anyways, those are the top picks. This is where you can follow me on Twitter at Mintzmeyer. 2-week free trials are open for the next 48 hours only. Mintzmeyer.com. Come check those out. I said we do some Q&A. I know we're running a little bit short. Mark, I don't know if we have time for maybe 1 or 2 questions. I know I kind of pushed it to the edge there.
Yeah, not a problem. We do have about a minute remaining here. Questions came in. They're wondering how much of an impact will the rising energy costs and wage inflation be on earnings for shipping companies?
Yeah, that's an excellent question. So first of all, the rising energy costs are translated into bunker fuel. So bunker fuel is what the final users of the ships have to pay for. Our companies, what they do is they take the ships and they lease them to the final users. So they're not necessarily operating them on a daily basis. They don't necessarily pay for the fuel. Their customers pay for the fuel. So counterintuitively, as the price of bunker fuel rises, which is what it's doing, the ship owners want to go slower, because when you go slower, you're more efficient. Think about yourself driving on a highway at 55, you get great gas mileage, right? Think about driving on a highway at 110, you get horrible gas mileage, right? A ship works even more extreme than a car in the same kind of curve. So the higher counterintuitively, the higher the oil prices and bunker fuel costs go, the better the market for owning ships. So it's really weird. It takes a while to explain, but that's counterintuitive. Wage inflation is a great question as well. A lot of the wages for seafarers are international. So I think Pakistanis, Bangladeshis, Russians, and so forth. The wages for seafarers have not moved considerably over the past year. I'm hoping they do. I want the seafarers out there to get their fair share and to get a pay raise. I think we'll see some wage inflation of 5 to 10%. I'd love to see more. I think they deserve it. It's a very, very small portion of the costs. And we're talking a couple percentage points. So it's not really marginal to the noticeable profits. Great question.
All right, excellent. A few people were wondering if they were able to acquire the PowerPoint slides.
I don't think I'll have a PowerPoint. I have to look into it. I haven't done this before, but I'm going to make sure the video gets out there, and I'll work with MoneyShow to make sure that happens. We'll make sure we can get it on YouTube or whatever the most friendly formatting is, and then that way you can pause the YouTube video and use the slides. It's basically the same thing.
All right, perfect. Thank you. And one last question here. They were wondering why are the container stocks correcting so sharply despite the very buoyant rates?
Yeah, that's a fantastic question. It's a struggle we have every day as we see the fundamentals getting better and better and better, and the stock price is going lower and lower and lower. The main reason behind that is a significant misperception of how these companies work and how the rates are structured in. A lot of people look back to tankers and what happened last year, right? Tanker rates went really, really, really high for like 2 months and they crashed, right? Lumber prices really, really, really high and they crashed. They don't really understand that these liner structures are for 3 or 4 or 5 years, right? So we're not talking about 60 days or 90 days. We're talking about 3 to 5 year contracts. So I think once the market kind of wraps its head around how this actually works and that they understand that this is sustainable for 3 to 4 to 5 years because of these contracts, I think we'll see a significant repricing. Right now, the market is pricing container ships like it's a 60-day boom and bust, and it's clearly not organized that way.
All right, well, we're speaking here with Jay Mensmeyer of Value Investors Edge, Head of Research. Jay, thank you so much. Great presentation today. We really appreciate it.
Thanks, Mark.